Hi, I'm Danny Michaels, certified financial planner and registered life planner. And today's presentation is going to be around creating tax efficient retirement income. Um, and so, this is a primary goal of anyone approaching retirement, is to try to figure out a way to create your retirement income by making it tax efficient as possible. So stretching your dollars as far as they go in retirement. And the reason why this is a primary goal for most retirees is because when you enter retirement, and you stop working, you have a lot more control over how your income is taxed. And the reason for that is when you're working and you have W-2 income, or you have self-employment income, or when you're in your working years, you have ordinary income from your employment, from employers. And so that income, there's only so much you can do to shelter some of that income towards tax deferred accounts like a 401k plan. You can maybe open an HSA account, those types of things. But when you approach retirement and you retire, really, your only fixed income sources are going to be, there's Social Security at some point for most of us. There's also pensions for some of us if you qualify for a pension from your employer. But outside of that, the rest of your income, unless you have like rental real estate, something of that nature, the rest of your income is going to mostly come from your accounts, right? You may have tax deferred accounts or tax free accounts, or or account that's titled jointly or in a trust. So this is where you're going to be drawing income from in retirement. And so um, you know, depending on where you draw that income from, that's going to determine how much taxes you pay on a year-to-year basis. And so, what I want to talk about today is, how you can create that income tax efficiently. We're also going to talk about some tax strategies as well. Something called Roth conversions, which play into the same strategy as far as determining which accounts you're going to draw income from. So the first thing that you need to do, when you're planning for retirement is taking a look at what your income is going to look like for the rest of your retirement. So everyone. So let's say you're a married couple. In this scenario, let's say one spouse is 58. Let's say one spouse is 55. There's like a 3-year age difference, and that's very typical amongst couples. There's going to be an age difference. And so what that means is that things like Social Security will start at different times. Things like required minimum distributions will start at different times. One spouse may retire before the other spouse. And so what you want to try to get a good understanding of is, okay, well, if we take a look and say, okay, let's say we both decide to take Social Security at our full retirement age. Let's say, and this is when our RMDs will start for each of us. And so you want to kind of project that out. And that's what we're looking at here. You can see that the purple, this graph is essentially looking at your effective tax rate of a sample, client, let's say. And this is going from age 58 and the bottom axis, age 58 all the way to age 95. And then on the left-hand side, those percentages represent your effective tax rate. Effective tax rate is the average tax essentially that you're paying. And the reason why you have three colors here, the orange, green, and the purple, as you can see at the bottom, that you have FICA taxes, which are your Social Security and Medicare taxes. So for those first couple of years there, age 58 to looks like about age 60, this particular person is still working, right? We know that because they're paying FICA taxes. Those are only assessed in your working years. Then there's some state tax, and then there's federal tax rate. And one thing that you'll notice, is with this person, they're essentially retiring at age 60 or 61. And what you can see here is that the tax rate drops, right? Their effective tax rate is at 25%, drops all the way to 5%, right? And then there's this big gap, at some point it starts to go up a little bit. And then age 70, you can see age kind of 74, 73, income really starts to kick up there. And, the primary reason for that is at age 73, based on recent tax law changes, used to be age 70 and a half, but now at age 73, you're required to take minimum distributions from your IRA accounts, right? So this gap, what we're seeing here is, hey, you're paying a lot of tax, almost 25% in the beginning of retirement. In your working years. And then once you retire, it drops to 5%. Then it kind of slowly goes up. But then towards the end of the retirement, the tax rate just keeps going up and up and up and up, right? Notice that trajectory, it continues to go up. And the reason it's going up like that is because once you start taking your Social Security and once you start taking your RMDs, what happens is that those amounts that you're taking out, and they're taxed at ordinary income tax rates, when those amounts start coming out, they typically will increase on an every year basis, right? Social Security has a cost of living adjustment on it. It's just over 8% for this year, 2023, which is the highest increase that in a long time. And then your RMDs, your required minimum distribution, is based on your age and the value of your retirement accounts and your tax deferred accounts. And so if the value in your accounts is going up over time, which they do if they're invested properly, right? If they're in the markets, they should be going up, anywhere from 5 to 8% over time. So those are going to go up every single year. And then also the way the RMD calculation is calculated is it starts at roughly about 3.8% in your first year that you have to take your RMD, so age 73, but then it's going to go up every single year after that. Right. And the reason for that is, the IRS wants you to use your retirement accounts for the reason that they were intended for, to create your retirement income. And so that's what you're seeing here, is that taxes are going up. So where there's some potential opportunity here, where retirees should really be focusing is in this gap here, right? You see that gap between age 60 to age 73. Well, in those 10 years, there's probably a lot of things that you can do to do some tax planning. And you want to make sure that you're making your withdrawals from accounts, they're going to make sense and they're going to kind of complement your tax plan. So this is what everyone should be doing, right? Running an income tax projection to get a good idea. Okay, well, hey, if we're going to be paying almost 25% down the road, and we're paying 25% today, well, maybe when our bracket drops there, maybe we want to start doing some things to increase income in that gap and pay some taxes at lower rates, because we know that we're going to have to pay higher taxes down the road. So we'll talk some more about that and how that's going to work. Now, types of qualified retirement accounts. So this is just a general explanation. So your traditional retirement accounts, so like traditional IRAs, 401ks, 403b plans, defined benefit plans, pensions, those types of accounts. You are putting money in there and not paying taxes, right? You're putting pre-tax money in those accounts. In the case of an IRA, you're putting money in and you're taking a deduction. So it's the same thing. So you're paying but then you pay ordinary income taxes on withdrawals, right? So that's essentially what's happening is that you're paying these income taxes on the withdrawals. And so income taxes are based on your marginal tax rate. So this is based on the federal tax bracket. And then you have your Roth accounts. Roths are after tax. So these are after tax retirement accounts. What that means is you're putting in after tax money, right? So, you earn your paycheck, you get your W-2, you pay your taxes, you have some savings after that. You say, well, I want to save this money somewhere, and so this is a place you could put them. You take that money you already paid taxes on, you put them in a Roth account. Because it's not pre-tax and you already paid taxes on that money that's going in there, the IRS basically says that when you withdraw these funds down the road, you already paid taxes on this money. So we're not going to tax you again. You already paid taxes. But also, because you forego that tax deduction, you didn't contribute to a traditional IRA, we're going to reward you by putting your after-tax money in this account by making all the growth in this account tax-free. So, give you some simple math. Let's say, you open a Roth and you've had $100,000 of contributions in there over time. After tax contributions you put in there. You retire, that account is worth, let's say it's $300,000. All the money that you take out of that account is 100% tax-free. And if your heirs inherit that money, it's also 100% tax-free for them as well. And one big distinguishing characteristic between Roths and traditionals as well is that there are no required minimum distributions in a Roth account. And part of the reason for that is the IRS, they don't have anything to gain, right? Because they're not going to get any tax revenue from you taking money out of your Roth account. So you could leave the money in there and let them grow. So this is a great wealth transfer vehicle as well for if you have kids or if you have grandchildren and you want to leave monies for them. Think about the difference between a traditional IRA and a Roth. Traditional IRA, you have to start taking the money out at age 73. In a Roth, you can let that money right in there. Let's say you live to age, let's just say 85. It's another 12 years. You let the money still grow in there. Then your children inherit it. Then they don't have to take the money out for another 10 years, right? They have to take that money out within 10 years. But in a Roth account, they can wait another 10 years before they take that money out, allowing all that money to keep growing tax-free. So just a really, really great planning tool to create some more tax diversification for yourself in retirement. And again, a great wealth transfer vehicle. Then we have your taxable accounts. And in your taxable accounts, you're going to contribute after-tax dollars. So this is, think about a account that's titled jointly or account that's titled, in your, in your trust as an example, or it could just be an individual account only in your name, but it's not a retirement account. It didn't come from 401k. It's not an IRA, just a regular taxable account. And the way that these accounts work is you put in your after-tax dollars, and then as you have earnings in that account, so capital gains, you're going to have to pay taxes, right, when you liquidate investments. So example, you bought a mutual fund for $20,000. It's grown to $50,000. You sell that fund for $50,000. You have to pay tax on that $30,000 gain. It's called a capital gain. And then that rate is going to be anywhere from 0%, depending on what your marginal tax bracket is. It can be anywhere from 0% all the way up to 20%. And so it depends on where your ordinary income falls. The other thing in taxable investment accounts is if you have dividends or interest in those accounts, it's going to make a difference because dividends are also taxed at these capital gains tax rates. So anywhere from, again, 0% to 20%. And any ordinary interest, so think about interest is paid by your bank. Or let's say you have some bonds in your investment account and it pays you interest. Any interest you receive is also going to be income taxable. So again, that's going to go back to your marginal tax rate, based on the federal tax brackets schedules. So what's really key to understand is okay, well, how do we position, some of your monies so that there are all these different little buckets, right? So that when you need to create income. So again, going back to that previous slide where we saw that gap, right? So that person doesn't have any income for, age 60, whatever it was, 61 to age 73. So, but let's say they have $2 million combined in all these three accounts. Well, the key question here is, well, where do you take the money from and how do you do that, right? What's the strategy with that? And the strategy should be getting a good understanding of what your marginal tax rate is. So again, you know what it's going to be in your working years. Now you have an idea what it's going to be later on in your retirement years, right? When your Social Security and your your RMDs and all those kick in. So that part in between where you have a lot of control for your for how you're creating your income, that's where this is really going to pay off for you. And so you may say, okay, well, based on the values I have in my tax deferred and my tax free and my taxable, I'm going to start taking income out of this, but I don't want to maybe. So let's actually go back really quick. So let's say you're going to be in that 25% bracket down the road. You're in this 25% bracket now. So you're going to say, okay, well, I want to make sure that I need to live off $150,000 a year, but I want to make sure that I'm never in a higher bracket than that, or even better. Maybe you say, you know what? I only want to pay up to say like 15% tax in these years here. So what you can do is you can control that, and the way you control that is having a good understanding of how these buckets are taxed. So again, money coming out of this tax deferred account, you can see it's pre-tax money going in, and it's the distributions out are taxable. And you'll notice that in here, the types of vehicles that we use for tax deferred accounts are, again, your 401ks, traditional IRAs, SEP and Simples, pensions, and then you have your any kind of qualified retirement plans, right? So all this money that comes out is income taxable. So if you take $50,000 out of this account, it's going to be treated to you as your ordinary income, right? Now, let's say that, but again, you need $100,000, right? So now you say, okay, well, let's just say as an example that $50,000 is gonna put you at a certain bracket, and you're close to the next tax bracket now. And you're saying, okay, well, I don't want to jump into the next tax bracket. And then the tax brackets, the way they work, they start at 10%, then they go to 12%. Then they go to 22%, and then 24%, and so forth, and then they go up from there. Most folks, especially in retirement, you're going to be anywhere in that, 12 to 24% range for most of us. And so you want to figure out, okay, well, where else is my money going to come from? So maybe what you do is, again, you take 50,000 from your tax deferred account. Then you say, okay, I got some money in these taxable accounts and I got money in tax free. Well, the next thing that you want to do is you want to maybe look at your taxable account here and say, okay, well, this is where money came in after tax. And then coming out, I know I'm going to have to pay, maybe capital gains taxes, right? If I'm selling an investment, I need to create more income from this. Well, so you want to try to understand, okay, well, maybe you want to sell positions that don't have a lot of gains, right? And you can do that and not create extra income for yourself. And so that'll keep, it'll give you the money you need to live off of, but it's not going to increase your tax bracket. And then let's say you need another 30 grand after that. And, there's no other positions to take from without realizing a large capital gain. Well, then you're going to want to look at your tax-free account, right? Your tax-free account, again, all the money comes in after tax, so everything comes out tax-free. So in here, we're talking about, your Roth IRAs, Roth 401ks, municipal bonds. Notice also in the taxable account here, right, that you have cash, stocks, mutual funds. So this is basically anything that you can think of, what we call capital assets that you would hold in a in a account in the name of your trust or jointly. This also applies to real estate, right? If you own an investment property, whatever you paid for that property, and real estate's a little bit special, has a lot of special rules to it. But let's say for simplicity, you buy a property for $400,000. You sell it for $700,000. And at the end of the day, whatever you pay, the cost basis of that property, what you sold it for, the difference is your capital gains, right? And so you're going to have to understand how those rules work, and you want to make sure that you're not going to just sell something and create this big taxable event for yourself, right? And or you don't want to take money out of this account, too much money. Let's say you take, you said, okay, well, I'm just going to take 150,000 out of here and neglect these two accounts. Well, the problem with that is you're going to just increase your marginal tax rate all the way to the top, basically, of wherever that amount is putting you at. And so you're going to basically increase your tax liability for that year. So you want to be really careful, understand what your income needs are on a year-to-year basis. And then again, with that income projection, with an income tax projection, knowing what tax you're going to pay down the road based on what your current plan is, now you can start to do some tax planning opportunities, right? You can say, okay, well, I know I'm going to be in this large bracket down the road, so maybe I'm going to take more out of my tax deferred account, maybe enough to where I'm going to stay under the 12% marginal tax bracket. So I'm going to live off some of this money. It's not going to put me in that higher bracket. And what I'm going to be able to do is also, because I'm taking money out of this tax deferred account, it's going to lower my RMDs down the road. Because remember, your RMDs are going to be based on what are the values are going to be in these tax deferred accounts. And so by taking money out of there, you're going to be able to reduce the balances in those accounts by the time you're 73, right? And so that's how you really want to start thinking about these accounts. So another great strategy, and you should absolutely, I don't want to give you tax advice. I'm just explaining the mechanics and how these things work. You should absolutely talk to your fee-only financial planner, or work with your accountant about these types of strategies. And accountants may or may not be able to help you here, because a lot of times they don't really know what's happening in the future, right? They're not running a tax projection for the next 20 years for you typically and saying, okay, hey, we know that's what taxes are going to look like down the road for you, so this is what you should do now, right? Accountants are looking in the past. They're looking last year. Okay, well, here's what you did last year. Well, here's what tax you owe this year. So you really want to you have to kind of know what's going to happen down the road. And then based on what we know today, that's the planning that we do today, right? To put you in a better position, not only today, but making sure that you're putting yourself in a good position throughout retirement. So Roth conversions, what a Roth conversion is, as you can kind of read here, the IRS allows anyone, regardless of your income level, to convert all or part of your traditional IRA funds to a Roth IRA. So, as a result, you're going to pay taxes on any funds you convert in the tax year you make a conversion. Any withdrawals you make in retirement are going to be tax-free. and then you don't have required minimum distributions like you would with a traditional IRA. I mentioned that before. And a Roth conversion can be extremely valuable in retirement, right? It's especially, again, if you're going to be in those higher tax bracket years in your retirement years down the road. So really what this strategy is, and again, I'm going to go back one slide here, is, this tax deferred account. Again, you never pay taxes on that money there. Let's say you have, $1.5 million in there, right? You retire, and you know that down the road, if you just keep leaving the money in there, and this is, again, by the way, what most people do. Most people will not take money out of their tax deferred accounts if they don't have to. And the reason is because they know they have to pay taxes. But you do not want to do that for most of us. And the reason is because what you're just doing is you're just deferring and deferring and deferring your tax liability down the road. And as I mentioned before, again, going back a few slides, this is why this happens here. That slope from left to right, starting at age 73, tax liability will continue to increase over time. It's because, again, your Social Security will go up over time. And especially if you never take money out of those traditional IRAs, that tax liability will start to kick in at that time. So that's not necessarily a very smart thing to do for a lot of folks. So what you want to do is you want to figure out, okay, let me go back again. You're in these really low tax bracket years here, and you're going to be in a 20% effective tax rate here. It's going to kind of continue to go up. So what this person might do is say, hey, you know what? I'm going to do what's called a Roth conversion for these years here. I want to do a Roth conversion to the top of the 12% federal tax bracket, or maybe to the top of the 22% federal tax bracket, because you'll probably be in that bracket down the road. So you're going to start to actually increase your income in these years here. So instead of not paying any tax, you're going to pay some tax, but you're going to pay them at lower tax rates, right? You're going to control how much tax you pay. And what that's going to do is it's going to get money out of those tax deferred accounts. It's going to stop this, hopefully, right? If you can. Again, everyone's circumstances are different. You again, consult with your financial planner or your accountant to really understand how this works for your situation, right? But what you can do with Roth conversions, you can really either really kind of level this off, or you can really, in a lot of cases, you can get it to slope downwards, right? To where, I have clients where we've gotten most of their tax deferred accounts, we've converted to Roths. And so what's happening now is, they still have some RMDs, but they're lower. And so now they're at the point in their retirement where they have a little bit of RMD, they have Social Security, some people still have pensions, but then they don't have these huge RMDs coming out, right? The rest of their money's in this Roth account, and it's growing tax-free for them over time. And so if they need extra income now, right, they don't have to get kicked up in these higher brackets. They can take it out of the Roth, and they can supplement their retirement income, and it's tax-free, right? That tax-free amount, because they're taking it out of a Roth, is gonna be excluded from bumping them up in those higher brackets. So what a Roth does is you take money out of this account. So again, let's say you're going to be in a 22% tax bracket down the road. And right now, with the income you're taking out of your tax deferred accounts, you're in a 12% tax bracket. So you say, you know what? I'm going to be in a 22% tax bracket down the road. What I want to do today is I want to do conversions to bring me up to that 22% tax bracket. Okay. But not more than that. And I'm going to pay some tax that I know I'm going to have to pay down the road anyways. I'm going to pay some today at this 22% tax rate. I'm going to get money out of this account, because remember, if you leave it in here, it's just going to keep growing and growing and growing. And then it's going to create, again, these higher income distributions down the road. Now that money's going to go over here. Let's just use round numbers. Let's just say you did $75,000, right? That $75,000 goes from this account to this account, to your Roth IRA. So from a traditional IRA to a Roth IRA. Some, by the way, if you have a 401k plan and you're still working, you don't have a traditional Roth IRA, some plans will allow you to do in-plan conversions. So you can do a Roth conversion from a 401k plan in your tax deferred account to the tax-free account, right? But you have to check with your plan administrator of your 401k plan. But what we typically do is, for most folks that are retired, they've already rolled over their 401ks right into their IRA. So what you do is you're taking $75,000 from here, you're putting it in this tax-free account. You're going to pay tax on that $75,000, right? You're going to pay a 22% federal tax rate. Then, depending on what state you live, you'll pay some income taxes as well. And then But then all that 75,000 goes into here, and then going forward for the rest of your retirement, and if you didn't use the money, and it goes to your heirs for that period as well, all that 75,000 grows tax free. And so, kind of a quick rule of thumb, I like to use what's called the rule of 72. It's just a quick way to get a good idea of how fast money doubles, right? So if you put 75,000 in that account, and let's say you take let's say you're getting a 6% rate of return. Okay, so your portfolio is giving you 6% rate of return. That $75,000 in that account, what you do is you take the number of 72 and you divide it by the rate of return, 6, and what 72 divided by 6 is 12. That means it's going to take 12 years for that $75,000 to double and be 150,000, based on that calculation. And so in 12 years, that 75 will be 150, but that 150 is completely tax-free because you've already paid tax on that initial 75,000. And so as that continues to grow and grow and grow, you can kind of see that snowball effect, right? So now you have 150,000 in there. Now, again, rule of 72. In another 12 years, if you're still getting 6%, now it's $300,000. And that 75,000 just turned to $300,000 in 24 years, and it's all 100% tax-free, right? Very, very powerful planning tool. And so this is something that, again, retirees should be using, 100% while you have the ability to. By the way, back in, I want to say 2010 was the year. Before 2010, if you had over $100,000 of adjusted gross income, you couldn't do a Roth conversion. So it was limited, it was capped. So over the last, over a decade or so, this has been a great planning tool for retirees to use because there's no cap on your income, right? You can do Roth conversions, in any amount, and it could make sense. And even if you're one of the highest tax brackets, if you're always being in that highest tax bracket down the road, and maybe right now you're still in a high bracket, but not as high as where you'll be down the road, it makes some sense. And again, it can be a great estate planning tool. So, this is kind of how Roth conversions work, right? Is again, you take that money out of a tax deferred account, you move it to a Roth account, and you pay some tax in that year. But now you're beefing up that Roth account. It's going to continue to grow tax-free down the road. So in practicality, here's how that works. Right now, what we're looking at is marginal tax brackets. So you can see that this light blue line here, this is the 10% bracket for this person. The green is 12 to 25%. So this is 12 to 15. And the reason why you see two tax brackets is right now we're in a 12%. That next bracket is 12%. But in 2024, that's expected, it's supposed to sunset and go back to 15%. These were, by the way, the rates that taxes were before 2018. If you remember in 2018, the TCJA, the tax, gotta test my memory here. Forgot the name of the act. The Tax Cuts and Jobs Act, right? That was passed in 2018. Lowered all the brackets, right? Lowered the bracket percentages. So 10% stayed the same, but 15% went down to 12, and 25% went down to 22%. So right now we're in some lower tax bracket years. So this is a great time, right, to look at these types of strategies. So we have 10% bracket here. The green again line is going to be your 12%, and then that. In this situation, in this scenario, the 22% bracket is that yellowish line all the way at the top. So this person is not in is never going to reach that 22% bracket. So what they should be doing in this scenario is potentially, depending on how much they have in tax deferred and tax free and in taxable accounts, maybe what they want to do is fill up to the 12% bracket in these years here, right? Again, this is the same example we're looking at before, starting at age 60, 61, where this person retires. Wait, I don't have any income, and let's say they have a standard deduction, by the way, so let's say that amount is, it's just roughly, and they're retired, let's say it's like around $28,000. Well, if you don't have any income and you have a standard deduction of $28,000 and you don't do anything, you're basically not using your standard deduction. So for anyone that knows they're not going to have any income in a year like the year they retire, what you can do is you can do a Roth conversion for $28,000 and just use up that deduction and not pay any tax on that. Zero taxes, right? And you just took $28,000 out of your traditional IRA account, you put it in your Roth 100% tax-free. But really what this person should be doing, because they know that they'll be in this 12% bracket down the road, it's inevitable. Well, hey, maybe it makes some sense to do a conversion to the top of this 12% tax bracket, right? And then what you're going to start doing is you do that every year, right? You start to reduce, again, this increased adjusted taxable income here, right? This is your taxable income without doing any kind of, a Roth conversion planning. So you could start to level this off, right? And then what happens is instead of you paying all this extra tax at this higher tax rate over here, right? You stay below this line, you pay taxes all the way through, right? And so that's how you should really start to look at your your retirement portfolio as far as creating income is, again, understand what your income tax is going to look like throughout retirement. That's the first step. And then from there, okay, well, what are our resources to work with? Here's how much we have in taxable. Here's what we have in traditional IRA. Here's what we have in Roth IRA. And then, okay, let's start to get to work in a tax plan. And another thing I'll mention here is this also goes hand in hand with all your income decisions in retirement. So example, when you take your Social Security, you might say, sometimes I'll meet with people and say, okay, well, we're going to take our Social Security at age 62. Okay, well, you can do that at 62, but then that's going to start creating some income for you over here. And then that's going to reduce the amount that you're going to be able to do for a conversion. And not only that, as you take your early Social Security benefit, it's also going to be reduced by as much as 25%. So it may not make sense to do that, right? Because if you delay it, the Social Security grows benefit roughly by about 8% per year. Right? So if you just let it continue to grow and you don't touch your Social Security and you push it out, you're allowing yourself more room to do Roth conversions. And not only that, but your Social Security benefit is now growing by 8% per year, right? By the time you take it, but let's say in the latest you can delay is age 70, now you got this bumped up benefit, right? Now your Social Security benefit could be 30% more than it was at your full retirement age. So let's say your full retirement age is 67. Now you're getting a 30% extra. So not only did you boost your Social Security benefit, but you became way more tax efficient with your retirement account resources. And so, that's kind of how you want to start thinking about creating tax efficient income in retirement. As you can see, there's a lot of decisions to be made, right? It's understanding your tax situation. It's understanding what you have in your different accounts and understanding all these tax rules down the road. Well, what's going to happen with, taxes down the road, like RMDs, and again, understanding things like Social Security, also pensions. If you have a pension, should you take a lump sum or should you take your pension stream? If you take your pension stream, again, it's going to limit the amount of Roth conversions you should take. And again, you can't just look at that aspect of it as well. You have to look at the pension and look at the math of the pension and say, okay, well, hey, if I take a lump sum and invest it over X number of years, or if I take the stream of income, here's going to be the difference, right? Here's the present value of this income stream compared to this lump sum. Does that make sense? And then you got to look at the tax situation as well. So there's a lot of things to consider here, but that's how you want to start thinking about your income, in retirement. So I'm Danny Michael, certified financial planner, registered life planner, and stay the course and good luck with your retirement planning.